Everyone, I'm Andrew with Jesani Wealth Management, and private equity as an asset class is always one of the most interesting to talk about within our multidimensional asset allocation strategy, really because a lot of investors are curious about it because it is the highest performing private or alternative asset class that's available to investors today. So it far outperforms private credit, far outperforms private real estate. There's some significant growth potential there. But of course, as with any investment, there's a trade-off that an investor really needs to be willing to make to seek out that increased return. But just a few kind of general numbers about private equity and why it's so interesting to a lot of investors. The S&P 500, as an example, averages about 8% per year historically, versus the private equity markets that average around 12, maybe even up to 13% annual returns. And if you look more specifically in the last 3 years, the private equity markets have commanded a 38% premium on return over that of the public markets. Now, this kind of brings in an important point to make, that the market cycle and your timing can have an impact on your overall investment result. So it's important that you invest in the right asset classes at the right times. And the cycle to do that can be 3, 4, 5, 6 years without making an investment in a certain asset class, just waiting on the appropriate time. Also, the private buyout market cap of privately traded companies has grown 3.5 times faster than that of the total market capitalization of public companies. So you really have a significant growth premium in the private equity markets. So one of the reasons why, and one of the things that a lot of investors aren't aware of, is that in the public markets, there's 2,000, or in the publicly traded market, and private equity is really any equity that's not listed on an exchange. That's the definition of private equity. So in the public markets, there's 2,600 companies available to investors that have $100 million or more in revenues. However, in the private market, there's over 17,000 companies doing $100 million or more per year in annual revenues. So you can see, if you're only focusing and looking for opportunities in the public markets, you're only accessing about 15% of what's out there. Also, one of the big differences between public and private companies is in the market cycle, or in the growth cycle of a company, a lot of that happens while it's a private company. And typically, once it goes public, the major growth phase of that company is well into the past. It goes public, the shares are diluted, it trades at a much higher P/E versus that private growth company. So private equity is really getting in early. There's also, of course, venture capital, which is a little bit different than what I'm going to talk about today. That's getting in very, very early. I'm going to focus on the buyout and growth private equity in this particular video. So there's the two kinds. You have venture capital, considered private equity. That's your unicorn companies, startup companies, where a venture capital fund may invest in 15 different companies and 14 of them go to zero. But the result and return from that one company out of 15 makes up for all the ones that they lost money on. So it's a very aggressive strategy. Growth and buyout is more, the fund is looking for potentially distressed companies, or companies where there's an opportunity to add value through active management or changes to the company. And they're looking at a 5 to 10 year market cycle to do that. They're buying into that company they like to acquire the whole thing, of course, when possible, but at a minimum of 50% ownership, managing that company, increasing its profitability and net income. And then there's an exit strategy at the end of the cycle, which can be 5 to 10 years. Typically, the sweet spot is about 8 years. Of course, there's different funds that specialize in different sectors. Some funds stick with all companies in one particular sector to have a repeatable outcome. Some funds are more kind of a a 30,000 foot playbook, and they'll go into any sector as long as they can acquire that company at the right price and they think that they can grow it. And this kind of leads into that private equity firms. So a lot of the big ones you've heard of, like Blackstone or Apollo or Carlyle or Hamilton Lane, underneath that firm umbrella will have many, many different private equity funds. Within each of those private equity funds that they're running, which from that fund you have the general partner who's managing that fund and getting the fee, and then you have the limited partner whose role is really to just provide capital. But within each fund, you have multiple investments, so they're acquiring that company. They'll acquire one investment in year one, another one in year two. So by the time you reach the end of the market cycle, you have consistent returns coming in throughout the exit strategy, which the exit strategy can be either then reselling that company in the private markets, or potentially at that time doing the IPO, taking the company public, and then either liquidating the shares in the sale of the IPO or in the public markets. I think it's important to kind of note here that within the private equity landscape, two of the top two quartiles of private equity companies account for over 95% of the transaction that's happening in that space. And those are the companies I just mentioned: Carlyle, Apollo, Bain Capital. I'm sure that you've heard of these companies. So there's certainly economies of scale happening where these firms are able to run several different funds and have many different managers working at the same time. But this kind of flows into what's called the private equity J curve, which is what I have right here. And this just shows the life cycle of a private equity fund. And you can see what happens in year one. They're making the purchase, making the acquisition of their target, and they're investing money into that particular company, and of course experiencing losses because of that. Typically around year 3, 4, or 5, they will start to generate profits, and then they rise significantly in year 6, 7, and 8. And then you're into heavy growth stage where they can then execute the exit strategy and either sell the company privately or, of course, take it public. Now, when you look at this private equity J curve, it really may not seem all that different from any other company. Let's say you start your own business. You're going to invest capital early on for growth down the road or long-term growth. But one of the strategies and the reason that leveraged buyouts are so powerful in the private equity space is they're able to leverage that return based on borrowing debt to basically increase the return exponentially. So I want to discuss real briefly what an LBO is and how it works in a simple sense, so an investor can understand it. So let's say I'm a private equity firm or just an individual, and I find a company that I want to acquire. And let's say that company is a really good, consistent business, and it generates $1.5 million in income before tax. After tax, it's left with about $1 million in income per year. The $500,000 comes off the top, goes to Uncle Sam. The seller of that company wants $10 million in order to sell the company. So I, as an investor, could certainly go in, take my $10 million, acquire that company, and then after tax, I'd be getting $1 million per year, which is about a 10% return. What a leverage buyout is, my other option would be to take $1 million of my own money, and for the other $9 million, I need to get to the $10 million to go find a bank that's willing to lend me that $9 million using, of course, the company being acquired as collateral, taking the total $10 million, $1 million of my money, $9 million of the bank. And by the way, of course, I'm going to have to pay interest on that $9 million loan. Let's just say it's 10% interest. So I'm paying right there is $900,000 per year that I'm going to need to pay in interest to service that loan. I buy the company, make the acquisition for $10 million. And let's say at year one, the income is the same, $1.5 million pre-tax. Well, the interest due would actually come out before the taxes. So the first thing I need to do is take that 1.5 million, subtract 900,000, and I'm left with $600,000. Then, of course, still have to pay tax on that income. So let's say a third of that goes to taxes, and I'm left with $400,000. But in the scenario of using the leverage or the bank's money, that $400,000 profit is coming from my investment of over $1 million. So you have a 40% return versus the scenario of me putting up the whole 10 million and generating a 10% return. So it's a very, very powerful strategy. And this is the reason why we see such significant growth in the private equity space. And by the way, this kind of factors into the private credit markets too, and why they've both grown so significantly is they leverage off one another. Growth in private equity creates more lending. Growth in the lending fund makes more credit available to private equity companies. So I want to go back to, with that leverage and those exponential returns, of course, I want to talk about the trade-offs and the pros and cons. But first, I really want to talk about kind of the performance, just so you can see, versus the public market. So here is total private equity net asset value versus public equity market cap. And you can see starting in 2000, in the public markets, you're at about 2.5 times versus private equity, you're at about 8 times. So obviously it's growing much faster than the public markets. Of course, one of the things you're going to sacrifice for that is liquidity and regulation, but I'll get into that in a moment. And then I want to go here. Now, I only went out to 2016 here, and that's because the past 3 or 4 years have just been astronomical returns in private equity. So I wanted to get a more fair picture of the long-term historical outcome of PE funds. And you can see that during that time period, that 20 years, the S&P average return was 8, right? I mentioned that at the beginning, versus the private equity average return is 12. But more importantly, here's the measure of standard deviation, which is one of the primary tools used to determine the volatility of a market. You can see that the S&P 500 has a higher standard deviation than private equity, which would mean not only do you get a higher return, but with lower volatility. Typically, it's the opposite. In order to get a higher return, you have to be willing to risk more volatility. But with private equity, it's the opposite, which is why these funds have become so popular. And I mentioned in the last 3 years, the private equity sector has done even better, and that's illustrated right here. So from 2018 to the end of 2021, you can see just astronomical growth. I thought it not really fair to include these numbers of the overall returns, but this has probably boosted private equity returns up to about 13%. So what's the trade-off? So the number one kind of barrier to entry is private equity funds have very high minimums, much higher than a lot of the other private alternative asset classes. So recently, some of those minimums have come down, but just 5 or 10 years ago, you had to have at least $20 million in investable assets and a $500,000 minimum for a private equity fund. Certainly, some of the bigger ones are still rather high, $5 million investable asset, $250K minimum, but there's also a lot of funds more recently and from some of the major players in the space that allow $50,000 or $100,000 investments and $2 million net worth. And there's even some funds out there where you just need to be an accredited investor, which is, of course, $1 million net worth or $200,000 in income. So one of the big ones is barrier to entry, high minimums. The second one, probably second most important as well, is liquidity. So private equity, if you invest in a private equity fund, it's going to be very illiquid, mostly probably through the entire market cycle, which, as I illustrated earlier, can be about 8 years. So you're locking that money up with no access to it. Some funds may allow access after 2, 3, 4, or 5 years, but you may pay a penalty to get those assets back. So for a lot of investors, that can be a big turnoff when they see they can go into the public markets, invest their money, get a decent return, and they know that they can access it at any time that they want. The another downside for some investors would be capital calls. So a lot of private equity funds, they don't take the capital from the investor up front. So let's say I identify a fund as an investor, and I say, yes, I'd like to invest $1 million. I do I read the PPM, the private placement memorandum, and do the offering docs. And the fund says, okay, we only need 200,000 of it right now. So now I've put 200 into the fund. I know I need to give them another 800, but right now that 800 is still with me, and I have to find somewhere else to invest it. And of course, most importantly, make sure I don't lose any money because the fund's going to call it, and I made that commitment. 9 months later, they may identify a target and say, okay, we're going to call another 400,000. 5 months later, call another 200,000. So that can be a bit of a turnoff for some investors, just because you have to find other alternatives while you're waiting for your capital to be called. The other big one is that when you're investing in a private equity fund, you really don't know what company you're investing in. You're really investing in the firm. So I mentioned some of the big names, or the particular general partners of that fund and their track record in being able to acquire, add value, and sell businesses within that fund. You have no idea what company they're going to go out and acquire next year, and you have no idea whether you're going to like it or not. So for some investors, kind of relinquishing that control and not really having any decision making on the actual companies that they're investing in can be a bit of a difficult pill to swallow. But if you're willing to have really complete illiquidity in it for the long term, make a capital commitment that's higher than most other funds, it can certainly be an attractive way to add growth into your portfolio. Again, kind of diversifying away from the public markets. And the low volatility that I mentioned before really comes from the fact that, let's say the jobs numbers come out today and they're up 15% year over year, which would be a crazy number, right? The whole market is going to decline significantly. It's going to be down 5-6% potentially, even though the businesses within that market or particular companies have not really lost any money and are not down. So when you're investing in anything that's public, market sentiment is going to really dictate the value of it on that particular time, a particular day. Private equity is a much slower moving animal that's truly valued on the fundamentals of the underlying company. And this actually brings up an interesting point. There are also private equity ETFs, which I've looked at very, very carefully. And quite frankly, in my opinion, the returns are not really any better than the public markets for this specific reason, because the ETFs, again, are going to move on a day-to-day basis and track the public markets and what's going on in the economy and what's going on with the environment and what's going on with the Fed. Whereas if you invest and put that money into a real private equity fund, you won't see that volatility. So if you'd like to know any more about private equity, I'm always available. My name is Andrew, Neil Jesani Wealth Management, and you can reach me at 954-800-8552. Okay, thanks everyone. Take care.